In 1980, a man named Nelson Nash was drowning. His real estate loans were charging him 23% interest. The banks held all the power. And then he discovered something that made every bank he'd ever borrowed from completely unnecessary. He didn't find a loophole. He found a mirror. Here's what nobody explains correctly about life insurance. Most people think of it as a bet on their own death. Pay premiums for decades. Hope you die at the right time for your family to collect. It feels morbid, transactional, a tax on mortality. But there's a version of this product that does something almost nobody understands. A specific type of policy, whole life, dividend paying, properly structured, builds something called cash value, real money, growing inside the policy every single year, guaranteed. And here is where it stops sounding like insurance and starts sounding like something else entirely. You can borrow against that cash value, not withdraw it, borrow it. And this is the part that should genuinely unsettle you. When you take that loan, your money doesn't leave the policy. The insurance company lends you new money from their own reserves, using your cash value as collateral. Your original balance keeps compounding, untouched, growing, as if you never borrowed a single dollar, which means your money is now working in two places. At the exact same time, you take the loan, you buy a rental property, fund a business, pay off a 22% credit card. Your policy doesn't know or care. It keeps compounding in the background like nothing happened. But then something strange happened when people started looking closer at who actually uses this. It wasn't just Nelson Nash. U.S. banks themselves, the very institutions that tell you to keep your money in checking accounts earning nothing, collectively hold over $200 billion in life insurance on their own balance sheets. Not for the death benefit, for the cash value, for the exact same mechanism they'll never recommend to you. The banks don't follow the advice they give their customers. And this is the part almost nobody talks about. The loan itself doesn't run through a credit check, doesn't show up on a credit report, doesn't require approval from anyone. It is, by contract, already yours to take. No bank committee, no waiting period, no explanation required. You're not borrowing from a stranger. You're borrowing from a version of yourself that planned ahead. But here's where it gets philosophically strange. The interest you pay doesn't vanish into someone else's profit margin forever. Depending on how the system is run, that interest can effectively flow back into your own compounding machine over time, turning a debt payment into something closer to a transfer between two accounts you both happen to control. It sounds like a magic trick. It isn't. It's just a different relationship with the concept of borrowing. Every dollar you've ever spent was financed one way or another. Either you paid interest to a bank, or you gave up the interest you could have earned by keeping that dollar invested somewhere else. Nobody escapes this. The only real choice is who profits from your need to access money. For almost a century, the answer was always the bank. This isn't really about life insurance. It's about something far more uncomfortable. It's about the quiet assumption most of us were never taught to question, that access to capital must always come from somewhere outside ourselves. That liquidity is something we beg for. That a stranger in a building decides whether we're allowed to move money when we need to move it. Nelson Nash didn't get rich from a clever trick. He got free from a dependency most people never realize they're living inside. The wealthy understood this generations ago. Not because they're smarter, because somewhere along the way, someone showed them the mirror instead of the loan application. This strategy isn't instant. It isn't for everyone. It takes years to build, discipline to maintain, and it punishes carelessness as quickly as it rewards patience. But the principle underneath it is the part that lingers long after the details fade. Somewhere right now, a bank is holding your money, paying you almost nothing, and quietly lending it back out to someone else at several times the rate. The only question left is whether you'll keep playing that role, or whether, one day, you'll finally become the bank yourself.